Hi everybody, this is Thomas Wynn from Wynn Capital with the 2025 fourth quarter market summary. On the screen is our contact info, so reach out anytime if you have questions or comments. Before we get into the summary, let's look at the graph of the S&P 500 for the last 12 months. On the left is the date of the election, and then we had a rally until mid-February when the tariff announcement caused the market to decline, then recovered in about July. And despite the daily chaos of administration policies, after the market recovered from the tariff decline, it rose in an orderly fashion for the rest of the year, ending very near the all-time market highs. Now let's take a look at the stock market for the fourth quarter and the asset classes. As you can see, everything was up except for global real estate. And for the quarter, as well as the year, international stocks, which are developed countries like Germany, Japan, and Europe in general, and emerging markets like China and some parts of Africa and Asia, undeveloped economies, were also up. So foreign is outperforming for the quarter and for the year. Now let's take a look at returns over the longer term, from 1-year annualized returns all the way to 20 years. Every arrow on the screen is up except for the 5-year returns of bonds, probably due to the 2022 decline in bonds, which was pretty significant. But over time, we've had a tremendous period of growth. In the 10-year period, super high returns in the US market. The foreign markets have outperformed over the course of the year, but you can see in every other period they've trailed the US market. Now we see the fourth quarter world market performance alongside the news. As always, it's a mix of positive and negative economic news, and despite the shutdown and a constant stream of disturbing headlines, the market closed out the year near its all-time highs. Lower taxes, declining short-term rates, deregulation, and excitement over AI and the potential for AI have been positives for the market. Now we're looking at the world market performance alongside the news for the full year. I've highlighted some of the headlines, and again, it's a mix of positive and negative news. On the positive side, there were more Fed rate cuts and stocks continued to rise. On the negative side, the credit rating of the U.S. was downgraded from AAA to AA, and the PE ratio of the market is now approaching that of the PE during the late 90s. Now let's look at how different types of investments performed in the U.S. The summary is highlighted over here, and the U.S. posted positive returns, and the U.S. underperformed the foreign and emerging markets. Value did better than growth for the period, and small caps underperformed large caps. And REITs were the only negative, performing poorly for the period. Now let's look at international developed stocks, and similar but not exactly the same as the U.S. Developed markets did better than the U.S. with very strong returns. Value stocks did a little bit better than growth, and small caps underperformed large caps. Now let's take a look at emerging markets where they performed very well and outperformed the U.S. Again, value outperformed growth for this period, and small caps underperformed large caps. Now we're looking at returns by country. As we've seen, the U.S. performed poorly relative to the rest of the world for this period, with the global average right here and the U.S. a little bit below that. Note the volatility of some of these markets. Over on the left, Korea and Chile almost 25% up for the quarter, while on the downside, China and Saudi Arabia close to 10% returns for the quarter. This next slide shows the performance for the quarter of commodities. Silver had a huge rally of 65% in the quarter. Gold as well has been on a tear, as some investors believe that metals are a hedge against inflation, despite data that shows otherwise. And the 1-year performance of commodities down here has been strong, while the longer-term 20-year average annual return has been negative. I want to note that in our portfolios, we own mining companies, many other companies that benefit from rising commodity prices. But we don't overweight them simply because, in general and over time, the historical performance of concentrated portfolios are worse than diversified portfolios. A diversified portfolio always owns the hot sector. Concentrated portfolios often miss the random sectors that the market loves in one year or another. This last slide is the very hard to follow advice to ignore the daily crazy news and look at the market over the long term. That is it for now. I hope you find this helpful. And if you have any questions or comments, please give us a call anytime. Thanks a lot. Bye-bye.